Hello, everyone. It's nice to be in SF. Thank you to 0x for having me. So, Will first asked me to talk about governance tokens, and I submitted some potential titles, and the most provocative title was chosen. And as I was actually building the presentation, I realized I may not actually agree with my own title, which is a bit of a conundrum. And the reason I may not agree with this title is if we think about it in number, as Will was just showing, in number, the majority of tokens are likely to be for consumers. In that, if we think of one CryptoKitty as one unique token, but then Bitcoin representing 180 billion or 200 billion in value, but that also being one unique token, then in number, this might be mistaken. And so I would like to change it to why most token value still may not be for consumers. And even this title gives me a little bit of anxiety. And I was expressing this to my partner Joel in New York yesterday, and he reminded me it's better to be interesting than perfect. And what I hope for from today is that actually this sparks some discussion, because I do think that the space has been overweighted on a focus on consumers. This was with utility tokens, or even Bitcoin's original conception as a peer-to-peer cash or a digital gold kind of overlooks how amazing of an innovation Bitcoin was in bootstrapping a supply side and a global network of producers that were able to coordinate around providing money over internet protocol. And so I'm trying to push back maybe a little too much on the concept of these things being for consumers and really taking a look at, okay, how are tokens good for producers? So structurally, I'm going to go over two things, really just first framing investors, producers, and consumers, and then relating this to 0x and other producer assets, or we could call them supply-side assets. There's different vernaculars out there. Oops. Okay, that's creative. So if we look at the economic stack, there's investors who are putting financial capital to work. That financial capital is often going to producers who turn it into productive capital, and that productive capital outputs goods and services which consumers consume. And what I'm going to be looking at is what happens when a producer is also acting as an investor versus when a consumer is also acting as an investor, and which leads to more constructive behavior. So one of the things when I'm thinking about our poor consumers is that they already have too many choices, too many decisions, too little time to do what is really important. And this is where I'm not sure that the average consumer wants to be thinking about more quantified things or more values. They want to use better services. They want to be more respected. And same goes for the producer side, but I worry a little bit that consumers may not have the time. Because in reality, consumers gravitate towards things that just work. They don't want to worry when consuming, and in particular, having to think about financial value at stake really makes them worry. And this is where more stable assets might be used more on the consumptive side, whereas the more volatile assets might be more for the production side. And if we go back to this investor, producer, consumer idea, we all wear those hats at different times. You can be purely an investor, you can be purely a producer, purely a consumer, and I kind of think about where you start first. If you start first as a consumer, which really happened to a lot of people in 2017, and then you fall into being an investor, that causes rampant speculation. That's when you're at the deli and someone's asking you about Ether or talking to their friend about the latest ICO. And I think that's dangerous. Now, on the production side, producers, they have to take on risk, just in the way in which you put inputs into something, you have an output, there's a delay, that time inherently has risk. Furthermore, producers within a specific industry have the expertise to assess risk, and many producers will take on more risk if they can profit more. And this is where a producer really also overlaps with being an investor and looking at the return on invested capital. And so what I would love to see, one of the things that I'm most committed to in this movement, is to see everyone participating in the capital appreciation that follows from the production they contribute to. And this is where I think of anyone that's laboring, anyone that's working is a producer, but most of the world's producers are not exposed to the capital appreciation. And so this is going to require, curious for an investor to say, but investors will have to take a step back. And there's actually precedent for this if we go back to when there were true landlords. People wanted to disempower their ability to just extract rents from the people who lived on the land. That's where the idea of economic rent comes from. And I think we're going to actually see a similar thing with shareholders in the years or decades to come, where an investor or a shareholder is important to initially capitalize something in a risk stage, and there are capital gains that come from that. But once a system is de-risked and operating at equilibrium, then I believe at least investors should not be able to passively extract profits. Instead, the majority of profits should be going to the producers. The consumers should be paying as little as possible, and actually when you have the investor in there, it makes things more expensive for the consumer, or it makes it such that the producer actually gets less of the profit. So that's providing some context on why I think it's really important to look at the producer side of crypto networks and how big of an innovation this is for those producers. It's not to cast off the consumer side of things. It's more, again, just to balance the conversation. So turning to 0x and other similar producer assets, those of you that know me know that I love this framework of superclasses of assets. It comes from a paper that Robert Greer wrote in 1997. And under these superclasses, our traditional asset classes fall. So capital assets, traditional assets would be bonds, equities, income-producing real estate. They're an ongoing source of something of value. They're valued on the basis of the net present value of its expected returns. Then there's the consumables, transformables, really our commodities, so oil, wheat, natural gas, bananas. You can consume it, you can transform it into another asset. It has economic value, but a key differentiator here is it does not yield an ongoing stream of value. And lastly, the most frustrating to value, the store of value assets, cannot be consumed, nor can it generate income. Nevertheless, it has value. It is a store of value. And so this is things like art or collectibles, or gold falls in this bucket. Now, gold falls across both the consumable, transformable, and store of value bucket. So applying this to crypto, I would argue we really started here. When Bitcoin was just this bizarre network, there wasn't really a market price. I think the first market price for Bitcoin was calculated as the marginal cost of production in late 2010, so the network had been around for about 2 years. It really wasn't until exchanges started to get going in 2011, and before we really had a market price, Bitcoin was just something you used to pay for block space. It was a consumable, transformable, didn't really have a financial premium. Now, it evolved to be thought of as a store of value, and this was a big deal that came out of 2017. If I look back to when I was at ARK Investment Management in the more traditional financial industry in 2014 and 15 and 16, I would have these dead-end conversations with people who would say, oh, it's digital, it couldn't possibly store value. And I think that in 2017, there are so many weird digital things that launched that actually normalized Bitcoin and normalized the idea that something purely digital could store value. Now, the next step is really staking. Staking takes us into the capital asset realm. And the reason I say that is any asset that is staked, bonded, or otherwise committed in order to get a claim on value flows is by definition a capital asset. Now, it's a little different from an equity because I can hold an equity and passively extract value flows, whereas with most staking assets, you have to be an active contributor to the network or an active delegator. And again, I think that is a really important differentiator because it makes it such that you can't passively extract value. And you shouldn't be able to passively extract value because you're not adding value in that process. Now, in terms of valuing such an asset, it's just the net present value of value flows to producers. This is great because it will bring more traditional analysts to the space, and actually part of making these markets more rational and less volatile is having consensus models to value these things, and then we can just bicker over the assumptions. Right now, we're all over the place in terms of the models and the assumptions. There's good work happening on the model front, and crypto capital, I think, will bring more people, more analysts into this sector. Turning to 0x, with 0x v3, the 0x staking mechanism gives market makers monetary rewards in ETH. As more volume flows into the 0x network, the fees and therefore the rewards grow proportionally. This, to me, is pretty clearly a community-owned capital asset. And that's great for all of the reasons I just outlined before. Now, a few side notes here. The riskier the asset that the producers get paid in, the higher the required yield. And this is why I really like that 0x chose to pay out its market makers in ETH. Now, the reason for this is if you're getting paid in a riskier asset, that just has more risk. People want to get paid more if they're taking on more risk. And so this is a little counter to, I think, what was once consensus thought, which was, well, if you have this native asset, all payments should be happening in that native asset, or all flows to producers should be happening in that native asset. I don't think that's the case at all. I think consumers should pay in whatever they want to pay. It can be fiat, it can be credit cards, it can be stable coins, it can be DAI. And then I think that producers will want to be earning in a relatively stable asset, or at least a asset that they know has less volatility than, say, the really long tail. And so this is an important consideration. Another side note, we already see competitive yield markets in DeFi. I expect to see them across any capital asset crypto network. And one way to think about this is if I'm a laborer coming to look at the world of crypto networks, and I can see these different yields, and there will be pages, we already have them, that show these yields, then if I see something yielding 25% for staking the asset and being a producer, while everything else is yielding 10%, then I'm inclined to go work for the 25% network. And in so doing, that asset will likely be bid up in price, which decreases the yield. And so in this way, it's similar to how some bond markets work. In this way, yield markets will in part help drive pricing. So here's an example of yield markets, and I think we're going to just see more and more of this. Turning to the governance token side of things, 0x is also the protocol's token that empowers 0x users to vote on ZEEPs that upgrade the protocol over time. This is on the more contentious side, I would say, and a lot of people question, well, how does this drive value? I think of governance tokens within a limited supply regime as a store of value. And an analogy we can use here is if we look at the Senate. Senate has had a fixed number of seats. I would argue those seats have gotten more and more valuable over time as the network of the United States has gotten more valuable. We may see them depreciate as the network of the United States gets less valuable. But so long as these seats are limited or fixed in supply and they're governing a more and more valuable network, then the ability to make choices around those resources or the parameters, I expect to get more valuable. And I can really only conceive of this as a store of value. With that, thank you very much.